Last quarter was a strong period for most asset classes, with global equities adding 9% in US dollars, listed property up close to 4%, and commodities up 7%. Over the year, developed market equities added 28%, their best calendar year return since 2009, while emerging markets added 18%. Bonds were also strong last year as interest rates fell, and spread investments in many cases posted double-digit gains for the year. US investment-grade bonds up 15%, convertibles up 17%, and dollar-denominated emerging market debt up 13%. The key factor supporting investment returns was the shift in central bank policy towards renewed loosening, led by the US Central Bank, in response to continued low inflation in the global economy. Now, policymakers have been much maligned in the post-financial crisis period, but once again, they took decisive action, which appears to have been wholly justified, given absolutely no signs the economy is running out of spare capacity. There was no resolution to the big macro risks, that's Brexit, trade wars, and the significant debt overhang in the Western world. But as tends to be the case, the global economy muddled through, and we're arguably closer to resolving some of these issues than we were at the start of the year. Trump's unpredictability means that trade war risks have not been eliminated, but if history is any guide, then it shows that a deal will ultimately get done, and the odds of a market-friendly outcome are boosted by the fact that this is an election year. On to Brexit. Trade negotiations start from a position where the UK and EU already have a deal in place, and many side deals on parts of the future relationship have already been agreed. Benign conditions and low but positive growth all contributed to good returns from most asset classes in 2019, and the funds were there to participate. The cautious fund added 3.2% last quarter, managed added 5.5%, and growth added 8.3%. Asset allocation was positive over the quarter, primarily as a result of the fund's positioning within fixed income. Global investment grade bonds returned not much more than zero, compared to gains of between 2 and 3% for dollar-denominated emerging market bonds, depending on tenor, 2% for short duration high yield, and over 2% for loans, all areas to which the funds are currently exposed. Manager selection was also positive over the quarter. Stanlib, our global investment grade bond manager, outperformed the market to a meaningful extent with a return of plus 3.5%. Our listed property manager, Third Avenue, also performed well, up 6.1%. Their returns were driven by their exposure to the US residential market, where fundamentals remain strong, and their UK positions, which benefited from the general election outcome, as well as the passing of the Brexit withdrawal bill. Fixed income has also been the biggest contributor to returns over 12 months. We have steadily collected a higher coupon compared to investment-grade credit and government bonds during the period, and also benefited from spread compression, consistent with our thesis that the global economy will continue to perform reasonably. Manager selection, and in particular the performance of equity managers, was the main detractor from performance in 2019. We have a balanced exposure across a range of equity investment styles in the funds, but positive contributions from our growth and quality-orientated managers were not enough to offset the underperformance of our value-orientated managers. We continue to believe that out-of-fashion value stocks offer strong future return potential. There was a brief but powerful recovery for value stocks in the first few weeks of September, which coincided with a sharp rise in bond yields. The power of the rebound, albeit short-lived, and the extent of the underperformance of growth and quality stocks highlight the risk that many investors are exposed to if they do not have a well-balanced exposure to stock markets at this juncture. The funds are all in line or ahead of their target outcomes to the end of December. For cautious, it has returned 5% per annum over the past 3 years compared to its target outcome of 4.7%. Momentum Global Managed has returned 5% per annum over the past 5 years compared to its target of 4.4%, and Global Growth has added over 8% per annum over the past 7 years, a compound return of almost 75% compared to its target of 5% per annum. Markets have come a long way over 12 months, but these moves should be considered in the context of the sharp fall in equities at the end of 2018, and hence, during the 15 months since the previous peak in markets, global equities have returned less than 10%. This leaves room for further upward progress. It's highly unlikely that we'll see the same cuts in interest rates that helped deliver 2019's high returns. Equally, however, there is no realistic prospect of reversal of policy anytime soon, so interest rates are unlikely to act as a headwind over the coming year either. The big macro risks are diminished in our view, and we may well get some fiscal stimulus to boost growth. Hence, the outlook looks good at the start of 2020. The trade wars are by no means over, however, and the effects of lower export demand are still working their way through the system. Economies are highly interrelated. One business shuts its doors, creditors find there's only 50 cents on the dollar in the remaining assets, and they lost money on their loans. They in turn cut their spending as a result, and another business starts to feel the pinch, and fewer customers coming through the door, and so on. This fact is not lost on us. Hence, we scrutinise the data continuously for signs of stress. We have levers at our disposal, including hedging instruments like options, should we feel the need to reduce risk in the funds. However, as I say, we are broadly optimistic. Some earnings growth should be sufficient to give us reasonable single-digit gains for equities, and while some companies look expensive, others are available at attractive discounts. We remain broadly diversified with exposure to a global basket of equities, including emerging markets, global bonds from across the credit spectrum, that's both high-quality borrowers as well as borrowers deemed low quality by the market, but who we in fact appraise as being good credits. Also listed infrastructure, listed property, cash and gold. Within equities, we are invested in a blend of complementary investment styles, meaning we should do well in a range of different environments.